Well, I think stocks can recover really based on 2026. Okay. So the most important thing to ask is, investors are going to try to focus on the next month or two and say, oh, well, the news is going to be bad. But that's not how equity markets work. Equity markets are thinking about 6 to 12 months ahead. And the real question is, are the tariff negotiations going to lead to a roadmap where 2026 earnings could be better than expected? And I think that that's possible. And if that's possible, stocks have a lot of upside. I think that if you're trying to look at stocks and decide to buy it every day based on the news coming out that day, you're making a big mistake. That would have kept you in cash since April 2nd.
Tom Lee takes a daring position right away. He claims that the current state of the market is both confusing and rich with opportunities. Investor mood is approaching severe pessimism. The Fed's policy stance is still unpredictable, and inflation data is giving conflicting signals. However, Lee views this as a setup rather than a breakdown. He cites historical examples when robust market recoveries were preceded by comparable fear-driven circumstances. He asserts that particularly in IT and riskier assets, the foundation for a rebound is being subtly established. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
But for the audience here, could you kind of recap those evidences that you see?
You know, we are in an unusual time because this tariff war has created a lot of uncertainty with businesses and consumers and trade partners, and of course the stock market. And markets went into a free fall decline from April 2nd to April 5th, so a 1 week period. And I think everyone's been struggling to understand whether or not the selling has gone too far. But we have seen some things that only happen after or near a low. And I've been detailing them in our research, but among those that are worth noting is one, we have seen stocks recover 50% of their losses. So that might be the most important thing, and that came last Friday. Because in the last 14 declines of more than 20%, 21 of the 22 never retested the lows after recovering half of the decline. So that's important. So when you can bounce back to get half of your losses back, it almost never goes to a new low. But the other things that we have seen, some of them are technical, like a Zweig breadth thrust, which is basically a 10-day moving average of advancers. That broke above 0.6. We had 2 consecutive days of 90% advancers. That's usually always happening after the low. And I think maybe one of the more important ones is that the high yield market, which is a leading indicator for equities, managed to recover again 50% of its losses. So when that happens, that generally helps stocks confirm the low. Well, I think stocks can recover really based on 2026. Okay. So the most important thing to ask is, investors are going to try to focus on the next month or two and say, oh, well, the news is going to be bad. But that's not how equity markets work. Equity markets are thinking about 6 to 12 months ahead. And the real question is, are the tariff negotiations going to lead to a roadmap where 2026 earnings could be better than expected? And I think that that's possible. And if that's possible, stocks have a lot of upside. I think that if you're trying to look at stocks and decide to buy it every day based on the news coming out that day, you're making a big mistake. That would have kept you in cash since April 2nd. There is a multi-fork roadmap ahead of us. We don't know what the tariff roadmap looks like, but I think the important thing to think about is, what has the market been thinking about? I think the market has been thinking about the downside risks, and they've been talking about the risk of a recession or a trade war with China that leads to economic Armageddon. That is why investors only think about the downside. The flip side of all this is that the US actually has a lot of upside for exports, a lot of upside for deregulation, a lot of upside for changing tax policy, incentives for creating investment in the US, and all of that would actually not only expand PE, but also expand earnings. So I think you don't want to get too specific, because at the end of the day, if cash on the sidelines is $7 trillion and investment sentiment is persistently negative, you don't have to be right. The market just has to be wrong. There's always a recession somewhere in the US economy.
Sure.
Like in the last 5 years, I might even say 20% of parts of the US economy have been in a recession. So that's why we call it a rolling recession. And the trade war is probably creating another set of rolling recessions. Now that doesn't mean the overall economy is in a recession, because GDP could just grow slowly as parts of the economy are in recession. I'll give you an example. Housing has been in a recession for 3 years now. And since 1900, prior to this period, whenever housing was in a recession, the overall economy was in a recession. But we've had a housing recession for 3 years and the US economy has been fine. So the question I think we're all trying to debate is, if we have a trade war recession, like so trade is slowing, is that enough to create an overall recession in the economy? Because we know it's creating a trade recession. And I don't have an answer to that.
Tom Lee's ability to combat the persistent worry that corporate profit margins are going to plummet is among his most insightful observations. He reminds us that many analysts projected that the S&P 500 margins would be irreparably harmed in 2008. However, they recovered. Despite the same cautions throughout COVID, margins remained high. Then the worry came back when the Fed began to raise interest rates. And once more, their forecasts proved to be incorrect. Lee's argument is straightforward. Profit margins are significantly more resilient than most people realize. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications.
But the one market I'm watching is the high yield market. If high yield spreads, which means high yield rates relative to risk-free rates, if that reaches 1,000 basis points, then we're almost guaranteed a recession. But it's currently at 367 basis points. So to me, the high yield market is saying we have another rolling recession happening, not a US recession. So that's why I was asking you to clarify, because I think it's going to be too easy for people to say, oh, GM's in a recession, so the economy's in a recession. GM could go into a depression and it probably wouldn't affect the US economy. But we don't want too many parts of the economy to go into a recession, because then that would drag the overall economy into a recession. Like what you're asking is, oh, if you have a rolling recession, why doesn't it pull everything into a recession at once?
Right.
And
at some point.
Yeah. I think that that's possible, but historically it's required what you call a shock. So for instance, if oil prices spike to $300 a barrel would cause oil to be 15% of US spending. That is a shock, because it's currently $50. But oil has to go up a lot. But in the past, that's caused a recession. The second type of recession is a financial system shock, like 2008. So if the financial system, the banks or credit, has a crisis, then that pulls all the sectors of the economy into a recession.
Right.
But if manufacturing's in a recession or housing, it doesn't create enough ripples. Just keep in mind that in 2023, when the regional banks got into trouble, many people predicted a depression, because they said, oh, the regional banks are going to be the firewall, and if they fail, all credit fails. But we had a regional bank crisis and the economy was fine. Anything is possible.
Sure.
So people can't say they know anything with certainty.
Yeah.
But in 2022, we had a series of rolling recessions that have continued, so for 3 years now. And in 2022, the S&P was down 27%, and earnings didn't recover until the second half of 2023. Investors at that time claimed the market was going to have more downside, because they thought the rolling recessions and the Fed tightening was going to lead to a bigger economic decline. We had argued strongly against that. We said that credit, the debt levels of consumers, was too low to prevent a larger recession. Today, the same conditions are true. Businesses and consumers aren't highly levered. So there is risk of job loss coming, and that's why we could have a recession. But for someone to be so confident that we're going to have a recession, I think they're dead wrong. Sure. And by the way, that's what you're hearing. I think a lot of economists are declaring recession. In my 30 years, I've never seen an economist get the recession right. So the fact that many are claiming there's a recession probably tells me the odds are very low of a recession.
Got it.
We usually go into a recession and economists deny it, and we're already in a recession.
Yeah.
That's what happened in 2008.
Tom Lee provides a much-needed dose of realism regarding the persistent scare tactics used in financial headlines. Lee strongly disagrees with the many economists and investors who are confidently forecasting a recession. He clarifies that rolling recessions, in which various economic sectors experience slowdowns at different points in time, do not always result in a complete economic meltdown. History demonstrates that a significant shock, such as a sharp increase in oil prices or a collapse of the banking system, is typically required to plunge the entire economy into a recession at once. Isolated slowdowns in industries like manufacturing or housing don't have enough of an impact to bring down the entire economy in the absence of such a catastrophic disaster. According to Lee, the economy is still doing well today. Unlike in previous recessions, consumers and businesses are not drowning in debt. Indeed, job losses are a possibility and anything may happen, but making rash forecasts about an impending recession ignores the wider picture. Furthermore, he vehemently disputes the frequently made assertion that corporate profit margins are destined to plummet. He has witnessed this same worry repeatedly in 2008 during the COVID pandemic and following the Fed's rate hikes. And each time, businesses have shown unexpected resilience. Time and time again, margins have stayed up because of automation, productivity, and effective cost control. He contends that American businesses' unwavering focus on shareholder returns makes them naturally superior at adapting. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.